Lazy investing is secretly one of the smartest financial strategies. When most people think about investing, they imagine this: people screaming on trading floors, charts flashing red and green, millionaires making split-second decisions, financial pros bragging about beating the market. And because of that, millions of ordinary people convince themselves that investing is too complicated, too risky, too stressful, too technical. So they avoid it entirely. But here's the weird part. Some of the most successful investors in the world don't spend all day trading stocks. In fact, many of them barely touch their portfolios at all. And ironically, the more lazy their investing strategy is, the better their long-term results often become. Today, I want to show you why lazy investing might actually be one of the most brilliant approaches to building wealth, especially if you're a normal person with a job, a family, bills, and approximately zero desire to stare at stock charts all day. Because the truth is, building wealth is often less about working harder and more about avoiding unnecessary mistakes. We've built this strange cultural myth around investing that successful investors are geniuses, that they can predict the future, time the market perfectly, find hidden stocks before everyone else. Social media makes this even worse. Every day, there's another headline: "This stock is about to explode," or "Turn $500 into $1 million." And honestly, it creates the impression that investing is basically gambling with extra steps. But here's what's fascinating. Professional investors, people who dedicate their entire careers to this stuff, often fail to beat the market consistently. Not sometimes, most of the time. There's an old statistic showing that over long periods, the majority of actively managed funds underperform the market itself. Even experts struggle to outperform simple index investing. That's a huge realization. If the experts can't consistently win, why are regular people trying to trade like hedge funds? And this is where lazy investing enters the picture. Not as a shortcut, not as doing nothing, but as a system designed around simplicity, consistency, and psychology. So, what exactly is lazy investing? At its core, lazy investing means building a portfolio that requires very little maintenance. Usually, that means owning a small number of diversified investments, typically low-cost index funds or ETFs. Instead of trying to pick individual winning stocks, you buy entire sections of the market. Think about that for a second. Instead of betting on one company, you're buying hundreds, sometimes thousands at once. That means if a company fails, your entire future doesn't collapse with it. This is diversification. And diversification is one of the few free lunches in investing. A simple S&P 500 index fund, for example, instantly spread your money across hundreds of major American companies. You own tiny pieces of businesses like Apple, Microsoft, Amazon, Google, Costco, Visa, all in a single investment. And historically, the broader stock market has tended to rise over long periods of time despite recessions, crashes, wars, bubbles, and panic. That's the key mindset shift. Lazy investors aren't trying to outsmart the market. They're partnering with it. Now, here's the part most people don't expect. Lazy investing often works better precisely because humans are emotional. We panic, we chase trends, we get greedy, we buy high, we sell low. A lot of investing mistakes are psychological mistakes. People see markets crash and think, I need to get out now. Then they sell at the worst possible moment. Later, the market recovers, but they never fully get back in, or they chase hype, cryptomania, stocks, AI bubbles, whatever everyone online is currently screaming about. Lazy investing helps protect you from yourself because the strategy removes constant decision making. You aren't asking, should I buy this stock today? You're simply following a system, and systems are powerful, especially in finance. Warren Buffett once said something incredibly important. The stock market is a device for transferring money from the impatient to the patient. The line explains almost everything. The people constantly reacting emotionally often lose. The patient investors who quietly stay invested for decades usually win. One of the smartest parts of lazy investing is automation, because automation removes willpower from the equation. And honestly, that's huge. Think about how many financial goals fail because people rely entirely on motivation. But motivation is unreliable. Automation is reliable. That's why automatic investing is so powerful. Imagine every paycheck automatically sends money into your 401k, your IRA, your brokerage account. No thinking, no debating, no timing the market. It just happens month after month, year after year. And over time, this creates something incredibly powerful: consistency. Which leads us to one of the most important concepts in personal finance: compound growth. Money starts earning returns. Then those returns earn returns. Then those returns earn returns. And eventually, time becomes more important than effort. Albert Einstein supposedly called compound interest the eighth wonder of the world. Whether he actually said it or not, the principle is still true. Small, consistent investing over decades can become large. The next part sounds boring, but it might save you hundreds or thousands of dollars. Fees. One reason lazy investing works so well is because index funds and ETFs are usually incredibly cheap, and tiny fee differences matter enormously over long periods. For example, a traditional financial advisor might charge 1% annually. That doesn't sound terrible, but over 30 or 40 years, that fee compounds against you, potentially costing hundreds of thousands in lost growth. Lazy investors often focus on minimizing friction: low fees, lower trading, lower taxes, lower emotional mistakes. Because investing success is often about what you keep, not just what you earn. This is also why many people now prefer flat fee financial advisors instead of handing over a percentage of assets forever. You can still get professional guidance without permanently giving away a chunk of your future wealth. There's another fascinating tool built specifically for lazy investors: target date funds. These funds automatically adjust your investments as you age. When you're younger, the portfolio stays more aggressive for growth. As retirement gets closer, it gradually becomes more conservative, meaning the system automatically reduces risk over time. You don't need to constantly rebalance everything yourself. For many people, this is as close to set it and forget it investing as it gets. And honestly, that simplicity is a feature, not a weakness, because the best financial plan is usually the one you can actually stick with for 30 years. I think one of the biggest misconceptions about wealth is that it's built through dramatic moments, big trades, perfect timing, massive risks. But for most people, wealth is built quietly, slowly, boringly. A few $100s invested every month, automated contributions, long period of patience, ignoring noise, staying consistent during scary markets. That's not exciting content for social media, but it's often how real financial security is actually built. And maybe that's the hidden brilliance of lazy investing. It gives you your life back. You stop obsessing over every market movement. You stop trying to predict the future. You stop trying your emotional health to stock prices. Instead, you create a system and let time do the heavy lifting. So no, lazy investing doesn't mean you don't care about your financial future. It means you've realized something incredibly important. Complexity does not always equal intelligence. Sometimes the smartest strategy is the sustainable one, the calm one, the consistent one, the one you can follow for decades. Because investing isn't supposed to consume your life. It's supposed to support your life. And if you can build wealth while spending less time stressed about money, that might actually be the smartest financial move of all. If you enjoyed this video, subscribe for more deep dive into money, psychology, and building a better financial life. And let me know in the comments, what's one of the financial habits you've automated that made your life easier? I'll see you in the next one.